Our session is on capital expenditure analysis. Here we take the financial math we have developed in the last several sessions and begin to see how it is applied in project evaluation or project investment analysis. We cover 4 topics, which are actually the 4 steps, the 4 principal steps in capital expenditure analysis. The first step is to characterize the project. The second is to estimate the project's cash flows. The third step is to determine the discount rate. And the fourth step is to calculate the net present value. The first step is to characterize the project by asking a few key questions. The first question is whether the project involves new business or no new business. That is, does the project generate cash inflows from new revenues, new programs, and new business lines? Or does the project focus on cost reductions and technological change and therefore no cash inflows? A second question is whether the project can be evaluated as an independent standalone decision or whether we're considering 2 or more projects that are mutually exclusive and we must select among them. And the third question is whether there is some artificial constraint on the amount of money that's available for investments this year. Now note that there's always a natural constraint that's imposed by the financial markets that shows up as how much money the firm is going to be able to raise for investments in this time period on good terms. Step 2 is to estimate the cash flows associated with the project. Specifically, we want to estimate the expected net cash flow in each time period, where net cash flow is the difference between cash inflows and cash outflows in each year. Now we're going to want to start with our best estimate or most likely estimate of all of the components of cash inflow and all of the components of cash outflow. We might think of the components of cash inflow as volume of sales, price at which we can sell our goods and services, and for those cash inflow determinants, what we want to do is to estimate as well as we can our most likely set of prices and our most likely volume of sales. For cash outflow, we want to know our cost function, which is defined by our fixed costs and our average variable costs times the volume of sales again. So what we need here is our best estimate of what our fixed costs are going to be, as well as our best estimate of what our average variable cost will be per unit of sales produced. Importantly, some of our expense items are non-cash items or non-cash flow items, and we're going to need to exclude those when we move from expenses to cash outflows. We want to measure all of our cash flow components on an incremental basis. That is, what we want to identify are the cash inflow and cash outflow components that are there if we adopt the project, but that won't be there if we do not proceed with the project. In identifying incremental cash inflows and cash outflows, all of the rules of differential cost accounting apply. So if you've had a cost accounting course, you know what these rules are, and I've got a list, or at least a partial list, of some of these rules here. Number 1, when you're determining incremental costs, you want to forget about sunk costs. So for example, let's say that we're considering a new business that will occupy land that we purchased 5 years ago for $2 million. The amount that we spent on that land 5 years ago is a sunk cost. It is irrelevant to the decision about whether to go forward with this new business opportunity. What is relevant is the amount of money that we could raise if we sold the land right now, which gets us to our second rule of differential cost accounting. And that is to use the opportunity cost of an asset or a resource as a measurement concept. So using our land example, if we can sell the land now for $3 million, and that's the best alternative opportunity for using that land, then the true or differential cost associated with using the land in this new business is $3 million. Rule 3 is to include working capital or cash and other current asset requirements of the new business opportunity. So if the new business opportunity requires that we add cash or accounts receivable or inventory to our balance sheet, that is an incremental cost that we need to reflect in our cash outflow analysis. Rule 4 is to include incidental costs or effects on other business lines of the project in question. So for example, if the project in question steals business from some other business line of our company, we need to reflect that effect as an incidental effect in our cash flow analysis. Finally, Rule 5 is to beware of allocated overhead. Let's say that our new business is going to be using management resources that already exist in our firm. If we're already paying the salaries of these managers and we're just asking the managers to oversee this new business line, and we thereby allocate some of their time as a cost to this new business, that would be allocated overhead. And if that allocated overhead is truly not differential, that is, does not involve additional salaries and wages expense, it's irrelevant and should not be included as a cash flow component. Step 3 is to determine the discount rate to apply. Discount rate determination is highly complex, and we're going to be spending a lot of time in the course in determining the appropriate discount rate to use to evaluate specific projects. For now, I'd like to introduce some basic principles of discount rate determination. First, the rule in terms of setting your discount rate is to use the cost of financing or rate of return imposed by the investors in the project. The process in coming up with the discount rate is to start with the overall financial structure of the firm and calculate the weighted average cost of capital, which will be our discount rate, or at least the starting point for our discount rate. Now, the weighted average cost of capital is equal to the weighted average of the cost of debt and the cost of equity. So we think of the investors in the project as debt suppliers and equity suppliers. Debt suppliers lend us money and charge us an interest rate. Equity suppliers purchase our stock and have a required return on equity that they expect. Now, what we want to do is to take the average of the cost of debt and the cost of equity, weighted by, where each is weighted by the percentage of our assets that are financed by debt or equity. So the weight for the cost of debt is debt divided by debt plus equity, or debt divided by assets. And the weight for the cost of equity is equity divided by debt plus equity, or equity divided by assets. Here's an example of a weighted average cost of capital calculation. Let's say the lenders are willing to lend us money at an interest rate of 3.2%. Let's further say that the required return on equity is 7%. If we have $60 million in debt financing for our firm and $40 million in equity financing for our firm, we have a total of $100 million in assets. then the weighted average cost of capital is equal to our 3.2% times 0.6 plus our 7% times 0.4 for a weighted average cost of capital of 4.72%. And that could be a starting point for the determination of our discount rate. If a project generates a positive NPV with a discount rate of 4.72%, that project generates enough cash to pay its debt service at 3.2% and to grow equity at least 7% per year, and in fact generates an additional amount that's equal to the value of the net present value calculated. Regarding inflation, we want to remember the key rule of inflation in these capital expenditure analyses, which is as follows. We need to be consistent with how we handle inflation. So we have a couple of choices. We can use nominal interest rates to discount nominal cash flows. That is, if the cash flows reflect an inflationary process, our interest rates or discount rates ought to be inclusive of inflation as well. Or we can use real interest rates to discount real cash flows. So if in our analysis we measure our cash flows free of inflation, then we should use inflation-free interest rates or discount rates. And we should get the same results depending on whether we use nominal or real figures. We'll come up with some examples of the effects of inflation in the various financial analyses a bit later in the course. Now let's apply the investment decision analytic model that we've been developing to IM&C's guano project that's in Chapter 6 of the Brealey and Myers and Allen text. What we have here is the summary of the NPV calculation for the guano project. Let's see how we arrive at an NPV of $3.52 million for the guano project. I've copied two tables or worksheets from this text into our Excel file. First we have table 6.1. Notice the structure of this worksheet. It looks a little different from the worksheets you've seen previously in the course. Specifically, now across the top we have the period indicated, and down the side in column B we have the cash flow components. So what we've done with this worksheet structure is essentially to rotate the worksheet 90 degrees from what you've been seeing. And we've done that so we can start our cash flow analysis using the operating statement of the project as a starting point. The project's operating statement is indicated in rows 6 through 12 of this worksheet, starting with sales, proceeding to costs, and going down to profit after tax. Let's look at the year 1 projected operating statement. In year 1 we project sales to be $523,000, cost of goods sold to be $837,000, other costs including labor to be $2.2 million, and then we have a depreciation expense of about $1.5 million, so that now in row 10 we have a pre-tax profit which is equal to sales minus all of these expense items to give us our profit, or pre-tax loss I should say now, of about $4 million. We have a corporate income tax that's equal to our pre-tax profit times a 35% tax rate. This minus $1.4 million in corporate income tax effectively means that because we have a loss on this business, that loss is going to generate a tax reduction for us of $1.4 million on our other lines of business. Effectively, this loss will offset some profits that we're earning on other business lines and reduce our tax overall by $1.4 million. And then the bottom line here of our income statement is our profit after taxes of about minus $2.6 million. I want to talk a little bit about this depreciation expense determination, the $1.5 million in depreciation expense. Notice that what we have is a depreciation expense of $1.5 million every year for 6 years. That $1.5 million depreciation expense is effectively spreading out the cost of the initial investment over the years that that investment is expected to generate revenues for us. The depreciation expense in this example was determined using straight-line depreciation. Straight-line depreciation takes a depreciable cost or depreciable basis and divides it by the number of years that the project or the asset will be used to come up with an annual depreciation expense amount. Let's see how the depreciation expense amount was arrived at. The initial investment is $10,000, so that's the beginning of our depreciation basis. From that amount, we need to subtract some salvage value, some assumed value of the asset at the end of the project. In the example in the book, the salvage value is $500,000. So I'm going to subtract that here. Okay, the difference between our $10 million investment and our $500,000 salvage value is $9.5 million in depreciable basis. Now if we divide that depreciable basis by the 6 years that the asset is supposed to be productive for us, we get our $1.583 million in depreciation expense per year. So in year one, we have a loss of, after taxes, of about $2.6 million. But as the project gains steam and starts to generate additional sales, in year two, we have sales of almost $13 million, growing to $33 million in year three, etc. So we have a business that's increasing in value. And while our expenses are rising as well, our sales or revenues are rising more rapidly, so that over time, our profit after taxes goes from a large negative to a moderately positive and then to quite positive in year four. The second table from Chapter 2 in the text is Table 6.2, where we convert the numbers from the income statement into net cash flow. So what we have is, let's look at year one again. We have our sales of $523,000. We have our cost of goods sold that we had from our previous table of $837,000. We have our other costs of $2.2 million. We have our tax amount of a negative $1.4 million. And then we have a total here that I want to discuss a little bit, which is cash flow from operations. Notice that cash flow from operations is defined to be cash inflows from revenues minus cash expenses, these two components, minus taxes, arriving at cash flow from operations. Therefore, and this is a very important point, cash from operations does not include depreciation expense because depreciation expense is a non-cash expense. So in the previous table, we needed to determine depreciation expense so that we could determine our net income for the year and thereby find what our taxes are. But when we come to estimating our cash flows from operations, we're going to want to exclude depreciation expense as a cash outflow component. Notice that our cash flow from operations increases over time, just as our net income or profit after taxes increased over time. Now, in addition to cash flow from operations, there may be cash implications associated with changes in our working capital balances. This new project, the Guano project, requires an infusion of cash and other working capital in the form of, let's say, current assets that we need to reflect in our cash flow analysis. So in the first year, we had to add $550,000 in working capital to our business. In the second year, we had to add an additional $739,000 in working capital, and we had that kind of going out through year 4, after which time we could take working capital back out as this business started to fade out. So the additional working capital requirements are a cash outflow requirement of the project as well that has to be accounted for. Now, if we add the cash flow from operations to the additional working capital requirements, we get the net cash flow provided by the project in each time period. So in year 1, this new Guano project actually reduces our cash by $1.6 million. But in year 2, we have a positive 2.3, etc. And the business generates positive cash spin-offs in every year after year 1. Once we have this net cash flow row, we can calculate the net present value. That's already done for us down here using a separate line which indicates the present value of the cash flows in each year. What I would like to do is to show you how to use our NPV function applied to the net cash flow amounts in row 8 to calculate the net present value. So let's just say we're going to put the net present value in this cell. And once again, we want to go up and invoke our function wizard, find NPV as the function that we want, say OK. Now we have a cost of capital or discount rate that's given as 20%, and that's written in as a percentage. I'm just going to write in here 0.2 for our discount rate, so that we have it in the format that the Excel function's used to. Then for the values, we want to highlight the dollar amounts of the cash flows for years 1 through 7, or for the full term of the project. Then we want to say OK. And then to complete, and this is now a present value calculation, remember, because it starts in year 1 and goes out to year 7. Then we want to complete our net present value calculation by going up to the formula bar and saying plus the cash flow in year 0. Hit enter, and we have our $3.5 million net present value.